Welcome, everyone. My name is Terry Ross, and I'm the Director of the Center for Corporate Sustainability. On behalf of the Haskayne School of Business, I would like to warmly welcome you all to this exciting discussion on sustainable finance in a post-pandemic world. The Center for Corporate Sustainability is focused on facilitating strategic conversations between business leaders, students, faculty, and practitioners in strategic areas, such as the current and future state of sustainable finance. Investors have arguably considered environmental, social, and governance risk in their investments for a very long time. However, these ESG trends have reached a new tempo and are catalyzing institutional change across the globe in a way that no jurisdiction can ignore. And as a region that relies upon developing hydrocarbons, Alberta is exposed to real and perceived risks from these ESG trends. We must understand how finance and capital can evolve and what are our options to adapt to these trends. I welcome you all to today's discussion and would like to begin with a territorial acknowledgement. The University of Calgary gratefully acknowledges that this event is not only being held in cyberspace, but also on the traditional territories of the people of the Treaty 7 region of Southern Alberta, which includes the Blackfoot Confederacy, comprising of the Siksika, Piikani, and Kainai First Nations, the Tsuut'ina First Nation, and the Stoney Nakoda, including the Chiniki, Bearspaw, and Wesley First Nations. The City of Calgary is also home to the Métis Nation of Alberta, Region 3. Now, today's event is complimentary and made possible by the generosity of many stakeholders. However, if you find the work of the Center for Corporate Sustainability valuable, I encourage you to support the Haskayne Business School with a donation of any size by following a link in the chat. Thank you in advance for all contributions. Our agenda is to have an engaging and productive discussion about the anticipated impact of ESG financial trends. We are very pleased to welcome Jackie Forrest as today's moderator. Jackie is the Senior Director of Research at ARC Energy Research Institute and is a subject matter expert when it comes to monitoring emerging strategic trends related to energy. She's an outstanding interviewer, and I warmly recommend that you download the ARC Energy Ideas podcast. Jackie will begin with opening thoughts before introducing our first panelist, Zvan, followed by Arlene Strom and Yrjo Koskinen. After each presentation, Jackie will discuss with the panelists some key takeaways. Then we'll move on to a general question and answer period. So please ask your succinct questions through the question and answer feature of Zoom, and our team will pass them on to Jackie to answer as many as time permits. And also, please consider upvoting any questions that you like. It is my great pleasure today to introduce Jackie Forrest. Over to you, Jackie.
Thanks, Terry, and thanks for inviting me to the event. I'm really looking forward to the discussion today. So I'm going to have a few minutes here of opening remarks, and then we're going to hear from the three panelists. As Terry said, the format will be hearing for the first hour from the panelists with some follow-up questions from me, and then we're going to have a Q&A at the end where we'd be happy to take some of the questions that come in from yourselves. Okay, so in terms of where we're at, it's probably better to start at where we came from. And if you can think of before COVID, that's how the world will be thought of before and after. Before COVID, things for sustainable investing were really looking quite positive. So some of the signposts, even this year, was the big announcement by BlackRock to pledge to much more seriously invest in ESG-friendly investments. So BlackRock, for those that aren't aware, is one of the world's largest asset manager with $7 trillion of assets under management. And they invest money for pension funds and public funds and state funds and even some sovereign wealth funds. And their assets under management are equal to 2 times the GDP of Germany. So very significant announcement. And the CEO of BlackRock said some things announcing this change, which were pretty important in terms of highlighting the importance of sustainable finance. So he talked about the fact that the world's on the edge of a fundamental reshaping of finance, that climate risk is investment risk, and in the near future, sooner than most anticipate, there will be a reallocation of capital to sustainable investing, and obviously their pledge was starting that. They did say they were going to divest of higher risk assets, but only talked about one specific asset, thermal coal producers, currently that they would divest from. Now, on top of that, earlier this year, there was really just a whole tsunami of corporate pledges to reduce GHG emissions by all sorts of companies. Would just note the most aggressive one yet, which was Microsoft, pledging to be carbon negative in 10 years. So not only were they pledging to reduce all the emissions associated with their company over the life of the company, but also get into a position where they were negative so that they could draw down all of those emissions that they ever put out. So that includes not only their direct emissions, but emissions associated with using their products called Scope 3 emissions. All right, but you know, the corporates weren't alone. Oil and gas in Canada also made major pledges. So Canadian oil producers that represent a significant amount of production. In fact, about half of production is backed by very aggressive greenhouse gas emission targets. So we've got 3 Canadian oil producers, oil sands producers, Cenovus, CNRL, and MEG, that have committed to net zero by 2050. And then you've got Suncor that's committed to a 30% drop by 2030, which is in line with the Paris target. So you put all that production together, that represents half of Canadian oil production that's made aggressive goals. And we'll talk about more of that on the Q&A. The other positive signpost has been the amount of capital raised by ESG-friendly firms. So based on an index by MSCI, back in 2015, only $60 billion was raised for ESG-friendly companies, and that has grown to $372 billion. Now, this is the direct opposite of what's going on for oil and gas, where generally the capital is becoming more and more constrained. Here in the ESG world, it seems that the capital flows are growing and continue to grow. Okay, the other thing to keep in mind around net zero that's worth talking about with Canada is that our federal government, the Liberals, ran under a platform of getting to net zero by 2050. They haven't put in any legislation yet, but that continues to be a goal. In fact, on the podcast that Terry mentioned, we just recently had Minister Seamus O'Regan, the Natural Resources Minister for Canada, talk about the importance of net zero and how he believes that could actually bring the country together. You know, there's a narrative today that if we're going to have an oil and gas sector, we're not going to make the Canadian targets for the Paris reduction of 30% by 2030 in this net zero. But if the industry could commit to net zero, which by the way, half of them, about half of them have very aggressive targets, then they could really contribute to this goal, and hopefully that could bring the country together. He also talked about the net zero is a moonshot. It's not easy, but we need to have these big goals so that we can work towards them. Okay, so that was the world before COVID, but now with COVID, there's lots more questions about what the future looks like. You know, today companies in the oil and gas industry and in almost any sector are really struggling. Are they going to be able to fund that moonshot? It's going to take a lot of money and investment to reduce the dependence on fossil fuels, to reduce methane emissions, to inject a lot of CO2 potentially from oil and gas operations, and to offset the emissions from other activities as well. And it will take billions of investment to get there for Canada alone, forget about the world. So where is it all going to come from? Is it going to come from green financing, which is growing? But many of the emissions in the Canadian economy, about a quarter of them come from oil and gas. And so will these green financing be available to some of these applications that would reduce the emissions for oil and gas? For example, hydrogen could be used to replace natural gas, and that would still benefit oil and gas companies. Could an oil and gas company raise green financing for a hydrogen project or a carbon capture and storage project? Those are some of the questions we'll be talking about today. And what will government's role be? There's still a lot of need for the development of technology in order to get these immature technologies more mature, more cost effective. And is government going to pay for that? And can they pay for that when you consider the cost that COVID has left, not only for the Canadian economy, for governments around the world? All right, before we get into the session, I want to have a quick polling question. So could we just put the polling question up? Because I want to get your opinion, audience, of the greenhouse gas emission goals. I talked about these corporations having the aggressive GHG emissions goals. And I'd like you to vote on if you think COVID-19 will change corporations' priorities for delivering on these goals. You know, before COVID, lots of goals coming out. Will we see an end to that and even a pullback on some of those previously made goals? So we'll just give it a few seconds here for you to answer the question. Okay, maybe we can share the results. Some people say no delay, about 30% of people. And 60%, the majority of people think that COVID is going to delay these goals for at least a few years. Very small amount of people say they will be delayed permanently, and a few people are unsure, but definitely a big group of people saying that we're looking at, we haven't gotten rid of the goals, but we'll probably put them on pause for a couple of years. So we'll hear the view of our panelists. But first, let's switch to our first speaker. Now again, I said the format is 3 panelists followed by a short Q&A after each panelist and then a broader Q&A at the end. So I'd like to introduce our first panelist. Barbara Zvan is the former Chief Risk and Strategy Officer for the Ontario Teachers Pension Plan. She was appointed to the Government of Canada's expert panel on sustainable finance, which delivered its final recommendations in June of 2019. I know I read that with interest, and Barbara and I have talked about it before, and we look forward to hearing an update on where everything's at. Welcome, Barbara.
Hi, Jackie, and thanks for having me here today. So I'm going to start with a presentation, just really briefly, just to give people some context in terms of what the panel did and some of its recommendations. So the role of financial markets isn't obviously being fully leveraged to help promote climate change. And that is really the impetus for doing this panel. It was about how to engage finance in, let's understand, finance won't solve climate change, but it has a critical role to play in the real economy through this transition. And so the panel was created in April 2018 as a cooperation between finance and the Environment and Climate Change Departments through Minister Morneau and Minister McKenna, with a quite broad mandate to consult with a broad group of stakeholders and to summarize what the challenges were and then what were the opportunities that we could address. We issued an interim report and received a lot of feedback as well through that process, and the final report came out about a year ago, and it has the recommendations. So for those who are keen, the report's online. And for those who are really keen, most of the context and rationale is found in the interim report. You can actually read them together and they flow well together. What you'll notice in the recommendations, it's really a systems approach. It has multiple things in it that need to happen by multiple groups, not just governments. Definitely there's a role for governments, there's a role for companies, for investors, as well as the citizens of Canada. So if we can move to the next slide. One of the first things we wanted to tackle was the definition of what sustainable finance should be or could be, because we heard a lot of different ones during the initial consultation period. And so we wanted to make it really clear it wasn't just, for example, just investing in green bonds. And so we really wanted to make sure that it was, people saw how expansive it really is. So it's about capital flows. So it's about lending and investing in terms of asset management, pension plans, that sort of thing. It is about risk management, so the type of insurance, how insurance is sold, risk assessment, which is a large part of what I used to do at Ontario Teachers. So how do you look at opportunities? How do you understand the risk of those opportunities? It includes the financial processes like disclosure. How does a company disclose? How does a financial institution disclose? About valuation. So how do accountants incorporate climate change into the valuation of an asset, for example? And it includes oversight. So what is the role of the board, the governance, the senior management team? How do we think about that? And really what we wanted to do was to channel the financial sector expertise, its ingenuity, its influence towards challenges and opportunities posed by climate change. So if we can move to the next slide. It really tries to touch on the key points of what we heard. And I still hear much of this today. So we heard that, what we saw definitely that there was definitely pockets of growth and really interesting things happening, but it wasn't coordinated and it wasn't mainstream. There was really not a sufficient view of how big this could be. And a lot of people thought it was really far in the distance and it wasn't something they quite had to incorporate yet. And they generally, I would say, a consistent theme across every group was difficulty assessing and accessing data and analytics, and how do you actually change climate information into something that's decision useful in the financial sector. There's some lack of clarity around fiduciary duty, which is a concept about when someone else manages money for people, how do they act, what do they need to incorporate? So generally they have to work in the best interests of the members. And so what does that mean in the context of climate change and ESG in general? There is a challenge around expertise, around benchmarks, which most of the asset management industry use and want to outperform, which generally don't incorporate ESG elements or climate change elements. The regulators are still in early stage. And so we really needed to accelerate the conversation and be more strategic about it. We move to the next slide. You'll notice throughout the report that there's really 3 imperatives. First, and a really important one, Canada's environmental and economic aspirations need to be one and the same, because ultimately they're indivisible. We won't be successful unless people start thinking about them together. The second is that we have some catching up to do. There's lots of measures out there, nothing is complete, but you can safely say Canada's not leading it and actually has an opportunity to lead in several spots. And we have a very strong financial sector, and we can become a leader and become a trusted source of solutions in definitely some parts of the sustainable finance. And really, we need to get sustainable finance mainstream. So simply just finance, and it becomes everyday, and that's really probably when we have reached success, at least in this area. If we move to the last slide, the report is structured into 3 pillars. And we did this very much on purpose because we saw the pillars being addressing 3 very different things. So first and foremost, the pillar 1 is about the opportunity. So we heard very different levels of excitement depending on the people thought about it as an opportunity or a burden. And we really wanted people to see this as an opportunity for change, an opportunity to make interesting investments. And so in this section, what you're going to see is recommendations around, hey, for key sectors, where are we going? What do we need to do in more detail than what is currently in the Pan-Canadian framework? And as we go to this direction, how much capital might be needed, and where can we access that capital? What might need to be government funded because it's very uncertain? What can we leverage the private sector for, and say, how do we enable that? That's really the key first pillar. In there, you might see some policy changes to encourage investment in this area, as well as an action council composed of industry leaders in finance to say that this is really important and help them move along the change. In pillar 2, we really saw these things as the foundations for market scale. So how do you actually take sustainable finance and make it mainstream? So in this pillar, you're going to see topics like data and access to data and interpreting that data. You'll see disclosure, and particularly the Task Force for Climate-Related Financial Disclosure, and how do we implement that in Canada? You'll see how do we support a strong ecosystem, the regulatory system. So these would be all topics in this second pillar. In the last pillar, we really wanted to tackle specific challenges that we heard in Canada. So that could be oil and gas, that is real estate, infrastructure, electricity, and so we tried to hone in on what were the particular challenges in each of those areas and try to come up with a solution, at least from a finance point of view. So I'll leave it there, Jackie.
Great, thanks, Barbara. So lots of stuff in that report. I encourage people to read it because we're not going to be able to do it justice in the 5 minutes of Q&A we have here specifically, but a couple of questions. One of the recommendations, maybe that's a bit controversial to some, is that we should open up the definition of what is considered green financing for Canada. And it really makes sense because the profile of our emissions, 25% of them coming from oil and gas, if we can't raise capital to deal with that, it'll be very difficult for the country to achieve its goals. Tell me a little bit about that recommendation, what the feedback has been. Do companies like BlackRock, who may define what they consider to be green, would they invest in a project, for example, that may be reducing emissions significantly from but it's going into the oil and gas sector?
No, you're absolutely right. That was a big concern of what we heard was funding for the oil and gas sector, especially the medium to smaller players. How might they be able to access it going forward? Green bonds are well established, especially at the government level, and they're definitely oversubscribed. But for our corporates, it didn't quite meet their needs. And so one of the recommendations, and we purposely didn't call it green, we called it transition finance. And, the concept was, what are the things that they can do today to start moving the needle around reducing their emissions? And then hopefully over time, the goal was to make that bar higher as we get closer to 2050. What would be considered transition? So the recommendation was actually to build out a transition taxonomy, which is just really a classification system. Are you meet the criteria or you don't? In terms of response, we've been really super pleased. There has been a group of private investors, asset managers, banks, insurance companies that actually have come together, and we're hoping around mid-August that they'll be actually ready to release an express document. So it's kind of like green bond principles, but it's for transition, as well as some detail on 3 of 7 sectors that they decided to focus in on. So we're pretty excited to see that. It does include as one of their principles that for these companies that they'll need to make a commitment around net zero. And so that would be a big indicator. And then hopefully that will add credence along with some level of assurance to investors that these companies are serious. We won't know until we get there. The good news is that this will be the first release. We will have lots of time to get feedback and we can change if we need to. Another big area is making sure it just doesn't stay a Canadian transition taxonomy, that we actually help internationalize it, and how does it work alongside the green taxonomy, for example.
Okay, great. So transition, not green, to help differentiate and to help people understand that. 'Cause sometimes there's a lot of shades of green too, so that could be a problem. Too many shades. So I like the idea of a different name. One other thing you recommended was that there's incentives that our government puts in place to get more people investing in these technologies. And there were some really novel ideas I hadn't thought of, like use the RSP. If you put your RSP into sustainable investing, you would get more of a tax benefit, or different tax rates or breaks for corporations that are investing in green. Have you had any discussions with the current federal government to understand if any of these ideas are being considered?
Yeah, so we worked pretty hard as we were developing these recommendations and to socialize them. This is our best advice to the government. What I can say, before COVID, we were having discussions on how to move these things all forward. One of the neat things was that the House of Commons Finance Committee's top ask was for this budget that was supposedly somewhere in the spring, around March, was that the government actually implement the recommendations from the expert panel as one of its top priorities. And we actually heard Minister Morneau at a breakfast, one of those large breakfasts early in March, so maybe it wasn't the greatest thing to attend at that point, but to say that they were committed. So at this point, that's really all I could share. I can say a lot of people are really excited about those recommendations, and I've had a lot of reach outs over the last few months while the government's been busy with COVID, with groups trying to add more detail around those recommendations to bring back to the government.
Okay, well, that would make sense. Raise the capital here in Canada from Canadians and give them that incentive and extra bonus. Okay, well, we're going to come back to some more questions. We're kind of cutting to the end of the time, but Barbara's going to come back on the panel. So thanks so much, Barbara, for those thoughts.
Great,
and
thanks.
for hearing some more wise views from you as we get into the panel. All right, I'd like to now introduce our next speaker. Arlene Strom has been with Suncor for 16 years. Since January of 2019, Arlene has been in the role of Chief Legal Officer and General Counsel for Suncor. And prior to taking on this role, Arlene led various portfolios, including sustainability and Indigenous and government relations. Arlene is the current chair for the Suncor Energy Foundation and also Suncor's Inclusion and Diversity Council. And I've known Arlene for a long time in some of those roles, and I really look forward to hearing your thoughts on this topic this morning, Arlene.
That's great. Thank you very much, Jackie, for that introduction. And thank you for inviting me to be part of this conversation. I think it's really important as we think about what the future looks like in a post-COVID world. So I want to, as we think about that, I want to ask for your indulgence to take a look backwards and look at what we have learned on our sustainability journey at Suncor. And I think what you'll hear is a couple of themes that come out in those lessons learned. And one is that we're in this for the long term. Our business is such that we have, heavy investments in capital. We almost think of it more in the oil sands and energy business that we're in as more like a manufacturing business, because we've invested billions of dollars in our assets, and then we don't have to explore for further resources, and we have a long horizon. So the long term is very important to us and always has been. In fact, we had our first climate action plan starting in 2000. The other theme that you'll hear me talk a little bit about is collaboration. And as we look at the milestones in our sustainability journey over the last 20 some odd years, many of them are directly or indirectly related to collaborating with investors, with government, with other stakeholders, with Indigenous peoples. And so those themes are very important. So I just want to touch on a couple of those milestones. And as I mentioned, when we look back, we had our first climate action plan in 2000. And around that time, we were also a founding member of the Global Reporting Initiative. And Barb was talking about, or in the report from the expert panel, they talk a lot about disclosure and its role, and that has been critical to us over the years. We had, in fact, our first environment report in 1995. Moving up to the very recent, we had our first climate report in 2017. And that was largely as a result of collaboration with an investor. We collaborated with NEI Investments when they put forward a shareholder resolution to our annual general meeting about increasing our disclosure around climate risk. And we were able to support that resolution, and accordingly, many of our shareholders voted in favor of it, and we went on to release that report. What happened as a result of releasing that report and collaborating with NEI is that we shifted our risk management of carbon. We had a reputation-based risk. We changed carbon risk to a principal risk of the corporation. And as a principal risk, it had regular oversight of the board, at the full board, as well as the Environmental Health and Safety and Sustainable Development Committee of the board. We have heard from our shareholders that good governance leads to strong environmental and social performance. And so that was a natural shift as we moved through that collaboration. We've also long believed in goals, and Jackie talked about the move within the energy industry with increased ambition to 2050. We started with a first set of long-term goals. We had 4 goals. They were all based on environmental goals back in 2009. And then in 2015, we refreshed those goals, and we had a GHG goal, which Jackie referred to, which is to reduce our emissions intensity by 30% by 2030. And as Jackie mentioned, we used and set that as a proxy to with the Paris Agreement. But we also put in place a social goal, which we felt was very important at that time to signal our ambition and the collaborative nature of our relationship with Indigenous peoples. We have gone from a relationship where we were primarily thinking about that in a from, we call it a from or to, where we were, where we were doing things, unfortunately, to Indigenous peoples or for them, so a to and for, and we've moved from that to with and of. And that social goal is walking side by side with Indigenous peoples, strengthening our relationship with them, changing the way that we act, think and act in order to strengthen that relationship. And so our goal has several areas, including increasing our business relationships with Indigenous people. Last year, we spent over 800 million with Indigenous businesses in Canada. So both of these goals are incredibly important. And I would say, as we move forward in a post-COVID world, this is more important than ever. We have refreshed our purpose to provide trusted energy that enhances people's lives while caring for each other and the earth. and we are more than ever committed to achieving our goals and to thinking further about the long term. We applaud the ambition of our peers and colleagues in the energy industry as they think about 2050. And we're also beginning to think about what that looks like for us and what is the right goal for the future for Suncor. So there's lots to talk about here, but I'm going to invite Jackie back to join me as we think about the implications of these lessons as we move forward.
That's a great summary, and your company's a real leader on this, so it's great to have your perspective and thoughts. I wanted to quickly talk to you about that Indigenous goal that you set out in 2009. I know you've done some pretty innovative projects with the equity given for the tank farm associated with Fort Hills, I think. Do you think that that's a model, maybe not just for Suncor, but in Canada, for big infrastructure, big energy projects going forward? Do you think that a greater part of the equity going to the local stakeholders, including Indigenous groups, is going to be a trend? And then also, your work in the Indigenous area, was that to reduce your business risk, motivated more by you, or do your investors ask you to do that?
Boy, there's lots in that question, Jackie. So, I'm going to start with governance because, as I mentioned, we think that strong environmental and social performance comes with great governance. As part of our commitment to good governance, we have had an Indigenous person on our board of directors since 2002, I believe. So a long time. So we've had that challenge and that relationship has been helped by having it as part of our governance. Our investors want to see us increasingly increase our ambition on social performance, and they see it as very important. So when we established our social goal, that was the second generation goals in 2016. That was after a lot of consultation. So we talked to Indigenous communities and Indigenous leaders about what they wanted to see from us. We talked to investors. We're a member of Ceres, and we do a annual or biannual meeting with stakeholders and Indigenous leaders that help us and prod us on our ambition and on our disclosure. So all of those things led us to, and a really important part of that is the relationships that we had with Indigenous communities. So we got to the East Tank Farm deal that you referenced because our current CEO had strong relationships with the leaders in the communities in Fort McKay and in the Mikisew Cree First Nation. And that really helped us to get to what are our mutual interests. And so we were able to do that. And now we have an equity partnership with the Aamjiwnaang on a wind farm. We are an equity partner in Petronor, which is owned by the James Bay Cree. And so our experience is that it's a great model. And I think there's opportunity to see more of this in big infrastructure projects in Canada.
Yeah, and I agree with you. I hope that is the case. I mean, to me, I think as part of reconciliation,
yes,
the way that the industry can really help by providing these opportunities. Okay, I wanted quickly to ask you, the first question that we talked about was, is COVID delaying some of your ability to spend capital on things like reducing your greenhouse gas emissions? And I wanted to know about, I think the biggest project you had on the books was replacing this coal-fired power plant up at the Suncor base mine to use lower emissions natural gas. What's the status of that project, and has it been impacted by COVID?
Well, in fact, that project has been impacted and delayed by a couple of years as we look to allocate capital towards it. But this is a really important project for us. Not only does switching to cogen help to reduce our own emissions, but we would plan to export power from this project to the Alberta grid. So given that cogen is the most efficient fossil fuel form of power, it's a really good base load form of power as we transition off coal onto more renewable. And so this is a really not only does it have those benefits, Jackie, but it's also makes sense from an economic point of view. Barb talked about the importance of sustainable finance having this integration between economics and environmental performance, and that cogen project is a perfect example of that. But we need to be able to allocate significant capital to that, and so it has been delayed a bit, but as I say, continues to be a priority project for us.
Mm-hmm. But it really kind of reinforces what 60% of the people said. You know, it doesn't delay the end goal, but it probably, you know, puts it on pause for a while as companies, you know, don't have any profit to fund some of these projects the way they would have before.
Well, and I was kind of interested in the answer to that question, because I feel like both, you know, the people who said no delay and some delay are right, because we continue to allocate capital to some interesting projects that, you know, for example, we just are investing $15 million in a biojet diesel project with LanzaJet and Mitsui and Nippon Airlines. And so this is a project where we're building a test plant. And this is, you know, could be a game changer in terms of reducing emissions for the aviation industry.
Yeah, and I was excited to see that. By the way, 90% of people, you know, agree that this trend isn't going away. That's another thing between the ones that said no delay and a few years of delay. Quickly on that, you know, funding that project, and I was interested to see that you released that even after the whole COVID thing, that you continued to see that as a priority. So that is not news that was released before that. Do you think it would be possible for Suncor to raise different type of financing, like a green bond? To me, that this project itself should be something that a green bond should consider financing. Do you think Suncor could use these type of tools? Is there any view on what the appetite would be?
Well, I'll give you a couple of perspectives, but I want to start with Mark Little, our CEO, was recently speaking at the Responsible Investor Association conference, and he did a poll question that was, what role should the oil and gas industry play in the energy transition? And the options were lead, comply, no role, or and the 85% of the folks at the Responsible Investor conversation said we should lead. So, you know, with that in mind, I think there is an appetite for companies like Suncor to participate in financing, and I like the framing that came from the expert panel around transition bonds. Currently, the taxonomy around green bonds is very limiting. You have to ring fence projects, and there's, you know, there's a number of limitations that, for example, would not make the investment in cogen at our facility green. And it's taking 2.5 megatons of carbon out of the system. It's contributing low energy power or low GHG emission power to the Alberta grid, and yet it wouldn't qualify. So I think there's a real opportunity in the transition bond space, and I hope there'll be more conversations and more development of what that taxonomy would look like.
Okay, well, that's a really interesting stat. So the Responsible Investment Group is a Canadian-based group of investors that are, you know, ESG compliant and really focused on. So that is really interesting to hear. That I wouldn't have expected that kind of response from that audience. So that's good that people are being open, because if we're going to meet these really challenging goals, it's going to be impossible to do if we aren't able to reduce emissions in every sector. And gas is very significant for Canada, for sure.
I've been sitting too still, Jackie. I have to. There we go.
Okay, well, thank you very much, Arlene. We're going to hear from you some more in the Q&A, but we'd like to switch now to our last speaker. Yrjo Koskinen is the Associate Dean of Research and Business Impact and Professor of Finance at the Haskayne School of Business. He's an influential scholar and thought leader in sustainable finance. Previously, he served on the faculties of Stockholm School of Economics, Boston University's Strom School of Business, and the Wharton School of the University of Pennsylvania. So welcome very much, Yrjo.
Thank you so much, Jackie. So the first poll is, do ESG programs create value for shareholders? Yes, it depends, the effect is uncertain, no, I don't know. So yes got 39%, and it depends on got 42%. So that's kind of that's a very high percentage of saying that okay, you can make money and it has shareholder value with these programs. And of course, sometimes it depends. So this aligns very well with the recent McKinsey survey. And McKinsey surveyed last sample of investment managers, CEOs, and CFOs. And 57% said, yes, ESG programs create value. 43% said uncertain or don't know. And only 3% said no. So vast majority of people think that ESG programs can create value. And this poll was perhaps even more positive than the McKinsey survey. So Lasha, if you can have the first slide now, please. So what I would like to emphasize is that, like the poll indicated, that ESG is not charity. It's a part of a normal operational business. And the way I view ESG activities, so environmental, social, and governance activities, that they are differentiation strategy for businesses that increase long-term profits and benefits shareholders. So it's part of a really long-term strategy. It's not a quick fix that quickly gives you profits, but in the long term, it typically pays off, especially if it's done well. So why should corporations engage in ESG? So how can they benefit from ESG? So there's a lot of research showing that serious companies that are very good at ESG have a lower cost of equity and debt, which means that they pay lower interest rate and they have to return less returns for shareholders, which means that their market capitalization or share prices are higher. Also, they have companies that are good at ESG have better access to capital, so actually can get financing. Whereas if you are very, very bad in ESG, you might not have access to capital at all these days. Also, what we know, especially in my own research, we found out that companies that invest in ESG have less volatile profits over the business cycle. So this is especially important in economic downturns, like we are now experiencing. That of course everybody's profits go down, but firms that engage in ESG, their profits go down less. Of course, there is no free lunch in a sense that profits are not always higher. I mean, sometimes if the economic boom, ESG costs money, and the profits could be a little bit less in an economic boom times. But they usually pay off when times are rough. Also, these days, a lot of young people, they like to be very proud of their companies, and then we help to solve the climate crisis, or we are doing a lot of social goods in our community. So ESG activities are a way of retaining your good employees and motivating them. And of course, we should never underestimate that ESG activities help to reduce the regulatory risks. So governments are regulating many industries and putting constraints on industries, and companies that are very good at ESG are better able to manage those regulatory risks. Lasha, you can have the next slide, please. So how about financial sector? Why should financial sector invest in ESG? So why should banks and asset managers use ESG criteria in investment decisions? Well, simply because investors and clients demand it. So individual investors, pension funds, so forth, they demand that there's a huge demand for ESG funds these days, or increasing demand for ESG funds and ESG investment criteria. So if you are listening to your clients, you should start thinking about as an asset manager or a bank, how do we incorporate ESG criteria in our investment decisions? So far, the returns on ESG have been spectacularly good. So it has been a great investment strategy. It's been earning excess returns. But I'm pretty sure that this is not sustainable, but pun intended. So this great returns for ESG strategies won't last. And this is the way the financial markets work. So far they have yielded great returns for investors because markets have underestimated intangible assets like ESG. So markets are sometimes very, very bad at figuring out how valuable are intangible assets. And ESG is one of intangible assets. But now markets have realized that, hey, ESG activities are valuable. No, the stock prices are going up. More and more money is flowing into ESG funds. And as a consequence, the more and more funds are flowing into ESG activities, the less profitable from an investor's perspective those activities are going to be. So the prices are getting higher and higher. The arbitrage opportunities, the great opportunities are disappearing. So perhaps soon we might have the situation that ESG funds, sustainable funds, are going to earn less money than the ordinary investor, ordinary mutual funds or ETFs, just because of there's too much money going into this business, and that easily happen. And then you would really see who's motivated as an ESG investor if you have to actually pay something for your ESG activities and not earn as great returns as your competitors who don't invest in ESG activities. So that could easily happen. Every good thing in financial markets ends at some point, and then we'll see when this is going to happen. Perhaps soon, perhaps in a few years. There's so much money going to ESG funds that all the good investment opportunities have disappeared. And finally, of course, there has been a huge trend in mutual funds and ETFs for passive management, index funds. And this is a great opportunity for mutual fund managers and ETF managers to get a little bit back to active management. So this is a very, very self-interested strategy for financial intermediaries. They can charge higher fees if they invest in according to ESG principles and engage companies that they invest in and become more active managers, so that they can justify higher fees. So there's plenty of reasons why financiers should also be interested in ESG. Lasha, one more slide, or two more slides, sorry. So I recently completed a study on stock prices during the first quarter of 2020. So this was done with the American sample, huge sample of publicly traded American firms. And we examined how did firms fare during the COVID-19 crash. So on the horizontal axis, we have time starting from 2nd of January until the end of March. And on the vertical axis, we have returns where we've taken out the effect of the market. So we know that market from peak to trough went down by 30%. So we kind of taken out the market effect. And now in this graph, we're kind of highlighting how much extra returns certain factors yield to the companies. So the yellow one is cash. So companies that have a lot of cash in their balance sheet. The red one is leverage. So companies that have very highly levered. And the green one is that companies that have high ESG ratings. Quite not surprisingly, companies that had a lot of cash in their balance sheet, it's spectacularly better during the market crash. Extra return that companies that have a lot of cash in the balance sheet was like close to 30% or 25%. So of course, if market goes down by 30%, these companies still went down by maybe 5%, but lost a lot less than the others. Similarly, if you have a little leverage, that was very detrimental to your stock returns during the first quarter. So highly levered firms had an extra negative return of 30%. So let's say if markets went down by 30%, you get an extra return of minus 30%, you're down to 60% already. So highly levered companies did really, really badly during the first quarter. And finally, the green one is the high ES companies. And surprisingly, that even taking into account that cash position and the leverage, high ES ratings had a very solid positive impact on stock returns. So the effect was 7.2% during the first quarter. So, and if you think of, you annualize that and then think about it, oh my God, this is like 30% annual return. This is huge. So ES strategies really paid off during the market crash. And I think one more slide. I just wanted to highlight how ESG funds, ETFs, and mutual funds did during the first quarter. So this is data for Morningstar, big data provider for mutual funds and ETFs, and it's divided between different regions: Europe, United States, Canada. And if you can see the first column, then mutual fund flows. The mutual flows to ESG funds, whether they are mutual funds or ETFs, was positive even in first quarter. When if you have a comparative figure for non-ESG funds, the fund flows were negative. So money was flowing out of ordinary mutual funds to ESG targeted mutual funds. And interestingly, if you look at which continent is really dominating ESG funds, it is still Europe. This is a mainstream activity in Europe. In terms of total assets, Europe has over 80% of total assets in mutual funds specializing in ESG activities. United States is fastly growing. It's roughly 15%. And Canada, of course, roughly the same space than US, maybe a little bit less, adjusting for size. So maybe right now, in terms of total assets, adjusting for population, maybe half of US assets. But the flows are getting there. That also Canadian mutual funds and ETFs that specialize in ESG activities are now gaining market share. They have positive inflows even during the first quarter, whereas the regular mutual funds and ETFs had negative inflows or actually outflows. So I think this, let's say if you can get Jackie involved, and we can have a couple of questions.
Great, thank you, Yrjo. So we just have a couple minutes here. So a quick question for you, and this also came through the Q&A. Could you describe variables from E, S, and G, environmental, social, and governance, that are really material, and maybe if they're not material now, that will be in the next little while, there'll be a growing focus?
So ES, I mean, from ES, of course, what is really material? It depends on industry. So for oil and gas, it's definitely greenhouse gas emissions. It could be for mining companies. It could be water usage, resource usage, other kinds of pollutions. For social activities, could be material could be indigenous rights, especially in Canada. How much you invest in your local community, how much you invest in your workplace. So those kind of things that are and of course, what is material really depends on which business you are in. So what is material for an oil and gas company is not the same as for Starbucks or for some bank. So material depends on really the industry on the firm.
Okay, good. And a growing focus. Like, it seems that governance, by the way, in Canada, just is, you take it for granted. You know, if you're a Canadian company, most of the governance stuff's there, but diversity is probably the one area that there already are more questions, especially around gender diversity. Do you think the Black Lives Matter movement could increase the focus of general diversity on corporations? So
it's definitely
ethnic.
Yeah, it definitely has already increased the focus on diversity. And that's going to be a long-term issue. I mean, it's not going to be solved overnight. And a lot of firms have to think about how many women do we have in top management? how many visible minorities we have in top management, how many indigenous people we have in top management. So that's going to be definitely, I mean, quite often we tend to concentrate on the E aspect, environment. And especially here in Canada, we talk a lot about climate risks and greenhouse gas emissions. But if you look at what affects stock returns, the S factors, social factors, affect as much as the environmental factors. So social factors are very, very important for stock returns.
Yeah, so it's going to be a growing sophistication to start. Today, I think the ESG, the font size of the E is like 24 and everything else is like 12. And really it's climate change, but I think that people are getting more sophisticated. Now we've run out of time for the panel. We're gonna open up and we've got more questions, Yrjo, that you can participate in part of the panel. So let's welcome back Arlene and Barbara. So we got lots of questions coming in. So we'll try to hit as many as we can and already got lots here. So the first question though, I want to hit you with, you know, you all did a great job of convincing me that this is a group area of growth, that people are going to care and do better if they invest in ESG friendly companies. But The Economist, always controversial, just had a cover a couple of months or weeks ago called The Trouble with Green Finance. And they argued that these activist investors that are demanding that companies do better on E, S, and G, especially the E to solve climate, are not going to be able to really accomplish much. They said that publicly listed firms, excluding state-controlled firms, are only about 15 to 32% of all global emissions. So, for example, all these state-owned companies in China, you're not going to change what they're going to do, investors. You know, you talked about, Yrjo, that these ESG companies do better, but you know, is the data really that reliable? I mean, some people say Tesla is actually a good ESG company. Other rating agencies say they're not because they have a large carbon footprint and the mining footprint. And so how do we know that, you know, you buy an ESG sustainable index and all the companies in it are actually doing good things for the country? And there needs to be more standards, which I think Barbara's recommendations also talked about. So their basic thing was governments can't just say, hey, we don't have to do anything, put our hands up, corporations are going to do all this, because really regulation is needed. And they argued we need, you know, big economic signals like carbon taxes to get people to change, to create the economic incentive to change. What do the panelists think about that? Do you think that government really needs to get involved and there's a concern that this movement could actually just make them feel like they don't have to do much?
Well, I can start. In the panel report, we tried to make sure it was clear that we didn't think the government was the only player. We thought it was, you know, governments actually have to do their part. There's investors, there's citizens, there's the corporations themselves. So it's not any one group that needs to solve this. I think it's all the different groups working together. And we did, and if you look at our recommendations, we tried to actually hit most of those groups in terms of the things they need to do. I wasn't totally surprised at The Economist article when we, you know, 30% of the world's oil and gas production is only public companies. The rest are those sovereigns. We try to make that point in the panel report, actually, that when you look at Canada, you're saying you're divesting in some of the best run companies. And so that doesn't seem to make complete sense. So how do we actually change the brand of these companies? And one was through disclosure. Let's start telling people what we're doing here, kind of like Suncor has benefited from, to actually say how are these companies transitioning and changing the conversation from divestment to differentiation, and including things like branding and labeling. That would also apply on things that other sovereigns will make, and then hopefully it would show up in their government bonds at some point.
So what was really surprising to me about the Economist briefing, I mean, of course, it's typical Economist fashion. It's very well written and very well argued, but they seem to concentrate on the scope 1 emissions. And they say, hey, only this much is publicly traded oil and gas companies. But if you include scope 3 emissions, I mean, you have to sell the oil somewhere. So if you start thinking about how much effect sustainable finance has had already on car manufacturers, I mean, Tesla is the world's most valuable car manufacturer right now. And so markets are betting on electric cars, and they're punishing Ford. And I mean, Ford is actually getting very, very serious about electric cars. But how many have you heard a car company called Nikola?
Yeah, they're developing a new semi truck and a new light duty truck, hydrogen based.
Yeah, exactly. And they haven't produced a single car yet. Yet they are more valuable than Ford right now, and then catching on General Motors. That's unbelievable. So markets are really kind of directing capital to companies like Tesla and Nikola away from GM and Ford. So that's kind of what's really missing in this Economist article is this kind of a dynamic aspect that markets are allocating capital to companies that are fostering new technologies.
Right. So if you look at the downstream effects, there could be a much bigger scope 3.
Yes.
Arlene, anything to add? And maybe you could just add a few thoughts. I know you probably heard this question a million times about the Norway Sovereign Wealth Fund divesting from Suncor, because it is a little bit related here in terms of some of the comments Barbara had made.
Yeah, well, and first of all, I totally agree with Barbara, as she's said. It takes all actors, right? It takes government, it takes industry, it takes other stakeholders. There's a big collaborative effort here. So, but what we can control is how we allocate our own capital. And so I think the focus for us is on allocating capital to both improve our base business performance and also to some of these new innovative technologies and so on that will help to invest in the sort of game-changing technology for the future. As far as the Norges Bank question, yeah, it is a question we get a lot. Listen, we worked with them for a number of years. We tried to help them understand where we were going, things like the latest technology that was being employed at Fort Hills, where the barrels that we produce there are, the emissions are equal to the average refined barrel in the United States. And it's partly because we're taking some of that carbon and basically sequestering it, taking it right out of the bottom of the barrel. And so it's technologies like that I don't think were taken into account in their evaluation. We really see some of the data that they were relying on as old data, and you know, it is what it is. But I can also say, Jackie, that we've just recently been to the bond markets, and as we seek to strengthen our balance sheet and during the COVID crisis and improve our liquidity just to make sure that we're strong for the long term. And our offering was oversubscribed. So we're still getting a number of investors that are willing to come with us on this journey.
Yeah, in fact, you had a couple of issuances of bonds since COVID, and I don't think there's too many other oil and gas companies in the world that have been able to successfully raise capital. So you're right, there are people that see the story, and I think it's really unfortunate because they had decided to divest of upstream oil and gas companies, but keep diverse companies with downstream assets like your own. And they're keeping companies, I think, with much less ambitious goals than Suncor has. We had a couple of follow-up questions, Arlene, on our discussion before. One, just a question on that petcoke boilers. What happens to the petcoke? Are you just going to ship it over to Asia and it's going to get burned anyway and there's no real impact?
Well, it's a live question. I think one of the options that we're seriously considering is sequestering it. So if you bury the petcoke, it's a form of sequestration and you're not transferring those emissions or just trading emissions. But we're a few years out from looking at that decision as we move forward. Okay.
And you'd commented about the fact that you have a 30% intensity reduction consistent with the Paris Climate Accord. But the question says, no, we need a 30% absolute reduction. So why is your target consistent? And then a follow on is, other players have made the net zero. You kind of implied that maybe there's discussions that Suncor would consider a net zero target. I'm not sure.
Well, look, first of all, I did not mean to confuse the issue. It is an intensity reduction target, and it was the 30% intensity reduction was only a proxy for the Paris Agreement, because we're absolutely clear that the Paris Agreement was absolute reduction. We felt it was appropriate at that time and was ambitious, and would have us investing capital in both improvement in efficiency and some of these innovative new technologies that help to, reduce our steam oil ratios and in situ and those kinds of things. So we felt like it was appropriate for the time. Look, and we completely applaud our colleagues who have gone with net zero goals. We are in the process of thinking about what's right for Suncor for a next generation long-term goal. And we want to make sure that we're thoughtful and it's the right ambition for us.
Okay, good. All right, let's talk a little bit about, and this is for Yrjo's comments as well as Barbara's, and I'd love to hear Arlene's view on this too, these rating agencies. So back to the charts that Yrjo was showing that showed ESG companies do better. There's real controversy, I guess, in terms of who is actually really a good ESG company and how they get measured. And there are these rating agencies like Sustainalytics, MSCI, who provide metrics to rate a company, if 10 out of 10 on ESG or you're 2 out of 10. And a lot of institutional investors rely on these ratings to decide, who they should invest in. Barbara, based on your time at Ontario Teachers, can you explain how important these rating agencies are in terms of decisions that institutional investors take? And Yrjo and Arlene, just some comments on what companies can do to do better. And I know Suncor's done quite a bit to understand that.
Yeah, I can provide some context. So, and I would try to differentiate between, say, the larger institutional investors who have in-house teams and they generally have responsible investing groups with skill sets that try to bridge, say, the climate, environmental, social skill set with the financial skill set. We would use many of those reports, and I say we, the broader we, in terms of peers and other plans, as actually a key data source, right? Like, it's hard to get clean, comparable, repeatable data on ESG still. Many of the funds in Canada are supporters of SASB, which is the Sustainable Accounting Standards Board, to actually get to that point one day. But we were using a lot of those data providers as kind of the key inputs, and we would have teams that would help interpret them. So we weren't as reliant on the ratings, say, as the more medium to smaller players, retail players, who just don't have the ability to bring that skill set internally. And so I would say, trying to add more clarity, better data, better standards around that data would really help all the different investors, big and small, to be a lot more efficient and a lot clearer in their views.
If I can continue on that, so before COVID, I was talking to a big hedge fund from Connecticut, American hedge fund, and I asked them, so do you care that all these ratings have only 0.6 or 0.5 correlation? And they said, we don't care at all. We don't even use public ratings. We do our own. So they have the analytical capabilities to scrape the data from the net, analyze it. So they don't use public ratings at all. They do their own. But of course, for smaller investors, this could be a big issue. As you well know that from the recent MIT study, we show that there's a positive correlation between different raters. So that's good, but the correlation is not that great. But of course, it also reflects the phenomenon that this is a very complex phenomenon. The same thing that we have been doing, we have been talking about corporate governance for ages. And if you look at the G index, that has a lower correlation between raters than the E and the S. So, I mean, this tells you that, these are not simple issues. The different raters measure different things, and you have to actually know what they're measuring.
Yeah, and their perspective would be, if you look at a bunch of equity analysts for a public company, some will have a buy rating, some will have a sell rating, and why should it be all uniform? Because there is a lot of interpretation of what risks are. And so, Arlene, what has Suncor done to score better or at least get the right information to these groups?
Well, I mean, we have participated in a number of these, rating programs and indices. We've also signed on to the task force to support the task force on climate-related financial disclosures. and have reported against that in our report on sustainability and climate report. This year, we're also reporting against the SASB requirements. And what we're seeing is there's a broad range. I mean, as Yrjo said, there are some investors that do their own analysis and they just need the data. And there are others that rely heavily on some of these projects. We've also been a member of or reported under the Carbon Disclosure Project for a number of years. So we respond to what investors need, and I would say we see equal importance on both the quantitative data that we disclose in accordance with these rating agencies, but also in our narrative that comes with how we manage risk. And I think that's one of the benefits of the requirements under the Task Force for Climate-Related Financial Disclosures, is it has us looking at scenarios and stress testing our strategy against those scenarios. And so that narrative then allows investors to say, you know, do they like our strategy or not? And so I think it's both the quantitative and the qualitative that comes from risk management that's very important to our investors.
Yeah, but you can see the kind of effort it would take, you know, for a company your size, you have the resources like to dedicate towards that, but smaller companies, it becomes a bigger challenge.
It's a real challenge because there isn't the uniformity around it, right? There are all these different, some investors use, use one of the indices to measure and another will use something else. So it's one thing for a Suncor to participate in that. It's much more difficult for when you don't have the same kind of resources and systems in place.
Okay, we have a question from the audience and around how Canada can handle the allocation of GHG reductions between different geographical regions. And this gets to, I think, a broader question I had thought of as well. In our recent conversation with the ARC Institute on the podcast with Minister Seamus O'Regan, he talked about, he felt that a net zero goal across this country could really bring Canadians together around this GHG reduction. You know, their narrative right now is, we're going to have an oil and gas sector, we're not going to achieve these goals, so let's shut it down. Some people are saying that. But if the industry could, you know, get the same goal and we're all rowing the boat in the same direction, we could get rid of some of the regional divides and antagonism around energy. What do folks think? Do you think, first of all, that that's the case? And do you think that Canada could actually achieve a goal like net zero 2050?
Well, I think
I think we have to.
Sorry, yeah,
Sorry,
go ahead.
Arlene.
I was just going to say a net zero goal. I mean, I can't speak for all this. This is a perfect example of what it requires right across. Like, it requires significant collaboration and significant improvement in performance across, you know, all of the industries, the building codes, the way we build our cities, the way we, you know, all of these kinds of things have to improve if we're going to. So I mean, I don't feel like it's my place to speak for others in this, but I think we have demonstrated that we think it's important to have significant ambition and to set goals and then begin to report against our performance in achieving those goals. Barb, what were you going to say? I interrupted you when you were.
Well, I was going to say, like, this is, as we said, like, in our report, we covered a lot of different sectors, and oil and gas is a quarter, but transportation is another quarter, and a good chunk of that is across Canada. You know, Jackie, you talk about it on your podcast all the time. It's between cars and light, heavy vehicle trucks and those sorts of things, and how do we get the infrastructure in place? You know, buildings, you know, we're a cold country. We don't do as well as a lot of other countries in terms of the efficiency of our buildings, and that's across the board. Electricity transmission, heavy industry, like, I think there's parts for all different parts of Canada. There's, you know, we acknowledge in the report of the significant challenge just related to Alberta, and it has to be a just transition, and we need to think about that as a country and actually work together on that. But there's a lot of advantages too. Like, our financial sector is quite concentrated, and you could put 30 CEOs in a room in Toronto and really have a good chunk of the financial sector and have a conversation about how it needs to change. And that's focused in one part of the country too. So I think there's many parts across the whole country. I think people just think of oil and gas because it's the thing that's most top of mind.
And can I add one other thing, Jackie? There are encouraging signs. Like Corporate Knights recently released a statement around what our ambition needs to be for the energy transition. And there were over, I think, I may have lost track of the last number, but 42 or 43 CEOs that signed on to that from a range of industries across the country. And I think that's the kind of collaboration that's required, and one that takes advantage of our unique strengths, like, you know, the natural resource base, but many other unique strengths that we have in Canada if we're able to collaborate.
Yeah, and I think that's a great point. I mean, I have to think that if we all have the same goal, and if the Western Canada shows that they can deliver maybe even faster than any other sector, that will be helpful in terms of the conversation on energy in Canada.
So Jackie, can I just add that I think if you want to be serious about achieving net zero by 2050, it has to be a huge increase in investment, not only in renewables, but there's no silver bullet. So there has to be a mix of maybe nuclear, hydrogen, carbon capture and storage, geothermal. So we need maybe perhaps the help of tax incentives to increase investments in all kinds of new technologies in order to achieve net zero by 2050.
Yeah, that's a great point. To this new IEA report that came out on Friday, really tried to highlight, you know, 2050 seems a long ways away, but actually when you think about the development timeline, but to go from, you know, demonstration to what, you know, your first commercial project to driving the cost down by deploying it a little wider to get it mature to maturity, that's like a 30-year cycle. So we actually need to highlight some of those key technologies now and start pushing those pilot phases so that they are available in 2050. So we had a question here from the audience about what technologies do you think that Canada could be a real leader on when it comes to net zero? And just for context, we actually had a poll on our podcast recently that the top 3 technologies were carbon capture storage, hydrogen, and small nuclear. You know, they were almost equal actually in terms of the votes. And Yrjo, you talked about geothermal. That one actually was quite low in terms of how people voted, but interested to hear the panel's views.
I think one of the other areas is just as we look at, you know, fuels. I mean, for us, we are in the, you know, fuels business, providing energy for transportation. And so, you know, another example of a collaboration that we had is with Enerchem, which is got a test facility, pilot facility in Edmonton that is producing cellulosic ethanol, so turning garbage into fuel. And so I think, you know, there's a real need for this type of fuel in North America. I think it's another area where we have some distinct advantage in that we have capability of running these kinds of plants. You know, Suncor seconded a dozen of our operational leaders to this facility to help get this thing up and running, and they've been producing more cellulosic ethanol ever since. And so, like, we know how to run big pots and pans. It's another one of our strategic strengths. So I think there's opportunities to continue investing in you know, low carbon fuels.
I think, I mean, hydrogen would be my favorite, because we have ample sources of natural gas here, and then so we were talking about so-called blue hydrogen, so not 100% clean on the green hydrogen, but blue hydrogen combined with carbon capture could make Canada, or Western Canada, a world leader in hydrogen. And those are complicated engineering processes, and we have good engineers here, like Arlene says, we know how to do pots and pans here, and that could be our competitive advantage.
Yeah, I'm really excited about the potential for hydrogen, and there's a couple of reports coming out this summer, one from the federal government, one from a panel here in Alberta, and I'm excited to see what they have to say. Barbara, any comments on technology before we go to the next question?
Yeah, I would just maybe point people, there was an interesting article in the Globe and Mail. It was called How Should Canada Approach Green Stimulus Plans? It was from the architects of Obama's strategy and some lessons. And they really encouraged, you know, the government to not hone in on any one solution, but really use the government money to help create and fund, you know, alternatives so that you can figure out which one might work best. And so let the private investors invest in things that are proven, and then really use the government money to help create the new technologies and prove them out. So I think that's an interesting approach. You don't want to spread the peanut butter kind of thing, but also you want to make sure that you're reaching out and really thinking ahead with that government money too.
Yeah.
Jackie, the other thing, sorry.
Go ahead.
The other thing I didn't want to get lost in this conversation is, you know, in a post-COVID world, I mean, demand is down now, but we see demand recovering. You know, things are going to be challenging over the next year, potentially. We'll see what happens with the second waves of COVID and so on. But we see recovery of demand. And so I think it's important also to think about, you know, as long as there is demand for fossil fuel, we need to continue to invest in our business, you know, in this business as well. And we need to continue to improve our costs and our carbon performance in this area. And so I think that's also an important part, is not to get lost in this, that we do have a strategic strength in the natural resources that Canada has and Alberta has, and we need to continue to invest in them over the coming decades. The fossil fuels are still going to be required.
Yeah, like in the 2-degree scenario, or less than 2-degree scenario from the IEA, you've got about 70 million barrels a day of oil demand, even out in 2040. And, you know, someone has to supply that. Why not have that from Canada? All right, we're coming close to our time. I want to share another question that's come in. ESG ratings aside, what happens if investors, especially, you know, foreign capital, just doesn't buy into our transition taxonomy and says, we want to follow the strict EU taxonomy? That's what the definition of green investing is. Would that mean Canada couldn't meet its goals? Like how, you know, Arlene, you talked about the fact you could still raise capital. So it may not mean that we can't meet these goals, just makes the cost of the capital a bit higher probably.
Yeah, I think that's true. I mean, I almost hate to answer that question, because I just sort of fundamentally believe it doesn't make sense to say that fossil fuel companies should not be part of the energy transition. We continue to allocate billions of dollars of capital. Yes, you know, COVID has created you know, capital scarcity, but we are still significant investors in this country. And if we're not part of the transition, that puts us significantly behind. So I think, you know, we need to have the right conversations. We need to have the right kind of taxonomy around this, and we need to make sure that that we're providing incentives for not only, you know, new energy companies, but fossil fuel companies to participate in the energy transition.
Yeah, no, great final thoughts. We're just closing up here. So if any final comments you have on that question, as well as some final thoughts from each of you. Yrjo?
So we know that Canada can access green capital. For example, Greengate, the solar and the solar power just received $500 million investment from Denmark, was in February, for the biggest Danish private equity investor in green energy. So that's, I mean, there's definitely no boycott against Canada. It's just we have to be a little bit creative. And for example, it's probably, it's highly likely that Europeans won't ever invest in our oil and gas. So we have to convince the American investors that they're still worthwhile investing in oil and gas. But also, we also could be more creative and then maybe do equity spin-offs or equity carve-outs, and then put the green assets in another company and the traditional assets in another company, and get funding for the green assets from Europeans. That could be possible.
Mm-hmm. That's a good idea. So they know that the money they're investing is going into, for example, the hydrogen project, maybe not the base oil and gas company. Barbara, any final thoughts on this question?
Yeah, to that point, there was one recommendation. It was to mimic what Climate Action 100 Plus was doing. So Climate Action 100 Plus is a global initiative, global investors targeting the 100 largest emitters plus 60 others that are important to that emissions in Canada. And, you know, before COVID, we actually were working with the Canadian Coalition of Good Governance, the Responsible Investment Association, Series, PRI, the Principles of Responsible Investment, and SHARE, and how do we actually do that. We were all set to do a webinar about the proposal in April when COVID hit, and we put it on the shelf for a little while. But I think that's really important to have that conversation because it keeps the Canadian investors in. We'd be open to having other investors in to actually have a dialogue and help promote the transition of Canadian companies and keep investors involved in these important sectors.
Right, well, so we'll look for that. Okay, well, I want to thank all of you. This has been just an insightful conversation. I've learned a lot from it. And thank you, audience, for all the questions you sent in. We got through a big chunk of them. I'd like to now turn the call over to Terry Ross for some closing remarks.
Thank you, Jackie. Today's session educated us about the nature of the systemic challenges and opportunities that lie before government and industry as we aim to reconcile our climate objectives, economic realities, and investment goals. And we need to keep having these strategic conversations with the right people in the room. A little bit of housekeeping. The video from today's session and the materials we made available on the CCS website, and keep an eye on your email. By the end of the week, we'll send out a follow-up email, which will have some instructions on how to access those, as well as a survey, which will help us improve our sessions. Thanks again to our moderator, Jackie, to our panelists, Barb, Arlene, and Yrjo, for your insights into the importance of ESG and where we should be keeping our attention. I want to thank our Haskayne team, whose hard work behind the scenes makes all of these events possible. And I want to thank you, our community, for joining us in the strategic conversation. You've chosen to spend your time with us, and we really appreciate it. I'd like to highlight our next Center for Corporate Sustainability event is the Enbridge Research and Action Seminar on October 6th, where we'll feature guest speaker Andrew Chisholm from the expert panel on sustainable finance and a former Goldman Sachs partner. He'll provide insights and guidance for business leaders about Canada's role in the global energy transformation. We hope to see you then. And finally, in the spirit of the emergence of sustainable finance, I'd like to share a quote from the MIT economist Rüdiger Dornsbusch. In economics, things take longer to happen than you think they will, and then they happen faster than they thought they could. So thank you. With that, I conclude today's session, and good day to you all.